Our major banks are predicting a housing price crash in 2023. So, what's the real outlook for housing prices? What's going to happen to interest rates? And what about inflation in the United States? Is that going to translate to inflation in Australia and higher interest rates and falling house prices here? That's what I'm going to discuss this week with Dr. Andrew Wilson in this week's Property Insider video. If you want to keep up to date with what's happening in our property markets, please subscribe to our YouTube channel and click the little bell icon so we can keep you up to date when a new show comes out. In the past week or two, three of our four major banks have changed their outlook for house prices. They're now predicting the biggest house crash in decades. Will they be right? Economists at the Commonwealth Bank and National Australia Bank are forecasting house prices to fall 10% next year, and Westpac's suggesting that house prices could only fall 7% next year, but they're going to keep falling 5% further in 2024. Now, these forecasts, of course, predicted on the basis of an assumption that the Reserve Bank is going to be raising interest rates later this year, and our housing markets are going to end up being collateral damage in the Reserve Bank's efforts to keep inflation within its target in the medium term. But how likely are these forecasts to come true? That's one of the topics I'm going to be discussing today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, in this week's Property Insider Chat. Hi, Andrew.
Yes, good morning, Michael. And it wouldn't be another week without some more heroic forecasts from the banks in regard to the outlook for house prices. But all will be revealed, and particularly, of course, the back end to all of this is higher interest rates, and that's the basis of these forecasts. When we do look at the historical record of house price declines, and we look at that ABS as the standard measure, and we measure from December quarter to December quarter, so that's annual changes. We see that the worst performance was in 2018 when national house prices declined by 5%. And previously, the previous most significant declines were 4% in 2008 and another 4% in 2011-12. And both those declines, 4%, and then national prices, of course, state and capital cities typically, of course, have different outcomes according to local factors. But both those declines in 2008 and 2012 came after a lengthy period of higher interest rates in a significantly booming economy. And we're going to have to see that, really, if we're looking at the easy part of analytics, and that's the historical record, to be repeated, but not just repeated, but these banks are predicting the steepest decline in house prices in Australia's modern history. So, wow, let's see how that one works out, Michael.
Well, they don't have a really good track record of housing market forecast, Andrew. I remember 2 years ago in March 2020, when the same economists who are making those, well, let's call them interesting predictions today, they similarly predicted double-digit falls of house prices to occur then. And that didn't eventuate. They underestimated the strength. They underestimated the resilience of our housing markets. Then this time last year, the same economists, they were late to the party, and only after our property markets had turned the corner almost 6 months earlier, they realised what was really happening on the ground, and they forecast strong price growth for 2021 last year. However, once again, they underestimated the strength of our housing markets and the strong price growth that ensued. But if house prices do fall by the amounts predicted this time around, that'll make it the biggest housing downturn in modern history. Now, sure, we've seen various segments of the housing markets suffer significant price falls, certain states, certain sub-markets, but we've never seen the overall Australian house market crash like this before, have we?
Well, no, and that's that explanation regarding that the annualized or the annual calendar year changes to house prices according to the ABS quarter to quarter, December quarter to December quarter, have shown us that 5% was the worst we'd suffered. And only 3 occasions have we had a decline in national house prices. So, and even as we've just said, Michael, they were following a lengthy period of higher interest rates. And I still think we've got a lot of water to go under the bridge in terms of getting our economy in a normalised post-COVID environment. And a lot of what we're seeing now, we're using as the, I guess, the ammunition for forecasts of higher rates are really factors that are reflecting what we've gone through over the last 2 years through our COVID restriction. Most of the inflation is coming from COVID-related factors, that is of higher fuel costs, which are basically supply line constraints, and similarly house building costs, which are a result of the stimulus package from the government flooding our housing markets with new contracts for houses. And we obviously don't have the labour or materials to support that in the shorter term, but we're back to normal in terms of what's coming through the pipeline now in terms of building approvals for houses. So eventually that will stabilise. But, anything for a headline, Mike?
Boy, are they getting them. But let's be clear, the Reserve Bank doesn't want the house market to crash. It wants it about as much as it wants another strain of coronavirus. Of course, currently the Reserve Bank interest rates are low. They're low to bolster the economy, to stimulate inflation, to increase wages. But once the Reserve Bank believes inflation is comfortably and consistently within its desired range, and once it believes unemployment's low enough to increase wages growth significantly, then it'll raise rates, but not to levels that are going to slow the market down. It's really just going to raise them to neutral rates. That's not going to be a very high rate of interest increase this time, Andrew, is it? Because of the indebtedness of Australians.
Well, I don't subscribe to the sort of the neutral. There is some sort of a magic interest rate level, which is neither too hot nor too cold, if you understand.
A Goldilocks. That's a Goldilocks interest rate.
Yes. I think everything changes, Michael, and what the neutral rate is through this cycle or this decade is different to, sensibly, logically, it should be different because things change, not just through COVID, but other changes that we have in our economy and in our society. And that means that the nature of monetary policy should be viewed as a movable feast, not something that's written on stone tablets that will never, ever change. The commandments of economic policy, because those that have followed those over the last decade have ended up with a lot of egg on their face. And we need to understand that this is a moving environment, that things change. It's an evolution of economic policy, and economists are not regarded as being those that are flexible in their thinking, I think, Michael, and that's the problem, that they believe these are rules that will never change. And we've seen significant change in those economic rules over the last decade.
Well, while falling interest rates have obviously stimulated demand, they've given borrowers extra capacity, they've increased housing affordability, rising interest rates don't necessarily cause house prices to fall, do they, Andrew? Unless they get up very high and after a while. That's where I think these predictions are wrong.
And the circumstances of the market are similar in terms of what we've seen, the impact with higher rates and lower house prices. And now, we're seeing a very strong period of housing market activity and higher prices, which really was a catch-up market from restrictions through COVID and pent-up demand being built up. That pent-up demand's being released. Affordability barriers are rising. It's almost a sort of a natural stabiliser that's acting on our housing markets at the moment. Banks forget we're going to see a surge. Economics basically should be about the basic fundamentals of supply and demand. That really doesn't change going forward. And what we're going to see is an environment in Australia's housing markets where we've got significant undersupply, and we're going to see a surge in demand. Now, that undersupply is evident on any measure you use, particularly given house rents going through the roof at the moment. But on the demand side, we're about to reintroduce hundreds of thousands of migrants into this country. For goodness sake, bank economists, where are they going to live? If we're not building enough houses now, and now we've got a flood of migrants coming back into the country from 0 to 200,000, surely that's going to put upward pressure on house prices, regardless of interest rates.
Well, the commentators are concerned that rising interest rates are going to cause mortgage defaults. Remember, last year there was a number of cliffs we were going to fall over, but in general, Australian households are richer than they ever have been. The strict lending criteria from the banks mean that those who borrowed over the last couple of years have got a buffer of at least 2% and now maybe even 3% for a rise in rates, which is unlikely to happen that high. And the other thing I find interesting is that most Aussie households, many Aussie households, have actually taken advantage of the low interest rates, Andrew, and they're 3-4 months ahead in their mortgage repayments. Mortgage stress isn't really on the radar at the moment, is it?
Well, whatever happened to the debt bomb, Michael? Do you remember the debt bomb? Well, that was an exciting headline for a while. For the last couple of years, we've been scared out of our wits by the imminent debt bomb. Well, we don't hear about that anymore. That's a done deal, and a sad old headline that is a little embarrassing for those that promoted it. But you're absolutely right. If anything, Australians are becoming more conservative in their lending activities, and the Reserve Bank governor, as I said, I believe that they've got up to a 2-year buffer on their repayment capacity. The whole point is, why would you have higher interest rates if your economy is ticking over quite nicely, and if your inflationary process is due to one-off events such as COVID lockdowns? But at the end of the day, our rates are so low that perhaps just to assuage the markets, and maybe the Reserve Bank governor is under pressure, he might just tickle those rates up from basically zero to just above zero, and then everybody's happy. But I don't think that's going to have much of an impact on house prices, and we can see that in the latest auction results, Michael, that particularly the Melbourne and Sydney markets that were had slowed down last year, they're back up and running this year, and maybe that's a bit of a surprise to some.
Yes, the market started very strongly. I think the other thing that could cause a housing market crash is severe unemployment and people not being able to keep up their mortgages. But I mean, the economy, as you say, is bounding along. Unemployment rates are low, and there's prospects of wages growth ahead. So I can't see households having any mortgage stress. But the other thing that's come up recently, of course, is the inflation in the United States at 40-year highs. And so people are saying Australia's going to follow. Is that a logical conclusion?
Well, why should it? I mean, inflation is in the US is well ahead of Australia's inflation rate. Reserve Bank governor has conceded it's completely different, the environment there. But it's the matching of inflation with wages that we need to watch, because as workers chase higher prices, they bid up their wages, which therefore can act for producers to bid up their prices. So you get into a wages prices spiral. But our wage response to prices is typically a lot stickier than the US, which follows inflation upwards in a more real-time environment. Their issues are the same in the US, fuel particularly. It's just that their wages are responding in a much more significant manner. We will see the wages index out next week, so that'll be the starting point of all these predictions of higher rates. But the Reserve Bank governor has indicated that he might not just be looking at that wages index, which is a little bit questionable in terms of what he considers to be wages growth in the economy. But if we look at interest rates in the US versus interest rates in Australia, and of course that's been another bit of a furphy in terms of, well, if interest rates rise in the US, given, as I've said, they're completely different circumstances in terms of inflation and wages, but given they do rise, and they are probably certainly more likely to rise in the US than Australia, why wouldn't Australia follow it? Well, the answer clearly is no. When we look at the relationship between US official rates and Australia's rates, they don't respond at all. We had a significant drop in the GFC globally in interest rates, and then Australia's rates went through the roof when we had mining boom number 2, as America moved into the, as they call it, the Great Recession, and they had zero interest rates right through until 2015. Now, our rates started to fall from 2012 onwards, so we were going down when the US was flat. But then in 2015, the US put rates up quite significantly over a significant period of time. At that time, we started to cut rates again. So we were moving in the opposite direction. And then the US started to cut rates, and our rates were steady through that period. So it is about local factors, and it's a very simple chart to look at, Michael, to compare US rates with Australia's rates. And you can see there's no quid pro quo in terms of the relationship. Local factors do determine what's happening at the end of the day, but as we've seen in the US and Australia. But of course, when we do have significant global forces working, such as the GFC or COVID, of course, everybody's moving in the same direction in that environment. But we don't typically also see, certainly in the modern era, a global boom in activity that pushes up rates. So again, we'll see interest rates likely rise sooner rather than later in the US this year, and perhaps Australia will move upwards, but its relationship is certainly a lot different to Australia in terms of the key drivers of interest rates, and that's inflation and wages.
We mentioned a moment ago how the housing markets have started with a bit of a bang, and the auction markets, especially the big auction markets this weekend, performed very strongly.
Yes, Michael, a big weekend for auction activity. Perhaps surprising on the upside, particularly Melbourne and Sydney. Sydney was again nearly 80% clearance rate. And of course, we regard that as a boom time result. That's 2 weekends in a row. And they're the highest results for Sydney since October last year. And it's not as though there's a shortage of stock. We're seeing record levels of February auctions in Sydney. So it's lots more buyers and lots more sellers in that Sydney market to start the year, and not slowing down at all. And auction prices are still tracking around 20% higher than where they were a year ago, Michael. And the Melbourne market, which was another market that ended the year, I guess, flattening from its boom results through the middle of the year, its clearance rates fell under 70% into the mid-60s. Well, it's been tracking in the mid-70s over February so far. So not as strong as Sydney, but certainly still a market where you would characterise it as being still a seller's market. And their auction prices are still tracking above where they were at the same time last year. So Melbourne and Sydney are off to a very solid start, particularly Sydney this year. Auction numbers are high, record levels of national auction numbers. The smaller markets, Brisbane, Adelaide and Canberra, Michael, they're just not looking at any sense moving out of boom mode. They're still very, very strong auction markets. And as I said, the Melbourne and Sydney have picked it up, even though we have the COVID issues, still with us. So I think COVID, as we discussed before, has really proven to be a nuisance rather than having a fundamental impact on our housing market. So, of course, markets will continue to ramp up now with listing volumes to rise. We have our first Super Saturday of the year in Melbourne in a fortnight's time prior to the long weekend, Labor Day holiday. There'll be a lot of auctions on that day. And it'll be interesting to see if the market can continue to absorb at the rate it is now. But clearly still a seller's market across the board, generally, Mike, the autumn market.
Lots of news still coming up, so we'll be chatting each week. But I think the message from our chat today is don't lose any sleep. Don't worry that the housing market's going to crash and the value of your home is going to plummet. Would that be a fair assumption?
Yeah, absolutely, Michael. And I think this is the point that we can sit here and talk about the validity of these forecasts, but these forecasts will change once the factors that they're relying on change. If they don't pan out, the high interest rates and higher wages don't pan out. All the banks will say is the data didn't support our position. We thought it would, it didn't, so we've changed our forecasts. We've seen forecasts up and down like the weather from the banks over the last 2 years. So that's fine. But the whole point is, other than questioning, it's their business, the housing market, you think they'd try to get it right once in a while, wouldn't you? But the other point to that is, you don't want to be making significant long-term financial decisions based on these types of volatile forecasts. To have a much more rational approach to your business forecasts in regard to the housing market, and certainly be looking at a more reliable model of outlooks for housing. And the real reliable model for housing, Michael, is just to look at the long-term journey of Australia's housing markets, and just about second to none, I believe.
Great. Look forward to catching up again next week, Andrew.
Thank you, Michael.